Assalamu alaikum. Welcome to question 56 of ATX revision kit. This question is from your section B of ATX question, and this is the last question that I'm going to do for my YouTube member for the March 2025 session. I've done 10 questions, so you can watch my 10 videos, the 10 revision kit solutions, and the 10 questions will be enough for your March 2025 preparation, so that you get a pattern of how a question appears. I have solved both 50 marks question, 6 questions in fact focusing on just 50 marks question, that is in your section A, and the 4 questions from your section B. So the questions that I've done is question 1, 2, 3, 4, 16, 19, then 25, 51, 45 and 56. So now let us do the last question for this session before I close for this session. It's on Louis, and this is from your March-June 2022 paper. Okay, so first let us quickly go through the requirements. A. Explain the circumstances under which maximum liability to IST will arise when you're gifting a gift. So you're gifting a cottage and you need to calculate the amount also. This question is very frequent. Maximum liability to IST, maximum liability to IST, and you have to calculate sometimes, and sometimes you don't have to calculate depending on the case study, and it's for 5 marks. B. Income tax and CGT implications on sale of shares and the reliefs that are available for capital loss, including the rate of tax saved in respect of each relief, and advise Louis of the most tax advantageous relief available to him. 9 marks. Because you have a lot of things to do. You have to first state the relief available for capital loss. Then you have to write the rate of tax saved under each relief. You might have 2-3 reliefs. Then C. Income tax treatment on the receipt of bank interest and payment of mortgage loan interest. Calculate the after tax. Even this is very famous. The after tax calculation. After tax net interest saving for the full tax year if he decides to repay the mortgage loan for 6 months. So first you need to calculate after tax, means first you need to calculate the tax, deduct the tax from your income. Okay, why net interest saving? Because when you're repaying the mortgage loan, when your loan is repaid, you don't have to pay the interest any longer that you used to pay. So you're going to save on that. Okay, after you deduct your tax, of course, from your interest income. So now let us read about Louis first. Always you need to know the person. What is his domicile status? What is his residence status? This will always be given in any question, and you need to first always see he is resident in which country and his domicile in which country and his deemed domicile. Based on this only you will decide whether he'll be charged for worldwide income or just UK income. That's why. So these are some information about Louis that you need before we move on to the actual transaction. It could be gift of anything. So he's a resident and domicile in UK. He has a son Mario and a daughter Sylvia, never married, has residential investment property. So residential means if it is CGT, it's 18-28%. Previously has been high rate taxpayer, but in this he was an additional rate taxpayer. Prior to this tax year, his income compromised non-savings, entirely non-savings. So now once this is set, next you will always be given the transactions. If you have 2-3 gifts, let's say you might give cash, you might give a property, you might give shares, it could be anything. So here it is about gifting a residential investment property on this date. This is worth 245, and before this he made a gift of 250 in cash on this date. Now they are going to sell the house. for proceed 366, and it will give rise to chargeable gain of 71,000. Already gain has been calculated and given to you. Now when you're acquiring shares and selling that shares, so basically for the first part, first requirement A, we don't need the sale of shares part, we only need the first part, that is selling of the cottage. So they told maximum circumstances which give rise to maximum IST, and you need to calculate that. So this is regarding a cottage, gifting of cottage, residential property. Okay. Always see whether it's a pet or a chargeable this thing. Whenever it is to a trust, it is chargeable, lifetime transfer, and when it is given to an individual, it's pet. Mostly they will give you pet. And the question is it will be chargeable or not. So this becomes chargeable if he dies within 7 years. That means before 31st July 2031. Why? Because the gift was made on which date? Gift was made on 31st July 2024. So just add 7 years to this. It should be 31st July 2031. Before this, if he dies, he'll be chargeable to IHT. So the maximum before he dies will be, even before 7 years, the worst case scenario is if he dies within 3 years, less than 3 years from the date of gift. That is 31st July 2024. Then there is no TAPA relief also that will be available to reduce your IST further. Because the question is maximum IST. You have to always assume no TAPA relief. That means he is to not die within 3 years and not die within 7 years also. So that it's not pet, it becomes chargeable. And in this case, remember they have given you a gift on this date, a cash. So this is within 7 years. Because this is within 7 years, this gift will also becomes chargeable when Louis is dying, because Louis is dying within 7 years from this date. And this will be accumulated in determining your nil rate band also. So you are not going to get nil rate band. How much? It's 250. So from 325, 250 will be utilized for just this gift cash. Then the remaining will be utilized against this 245 cottage. See, now you will calculate the maximum. So what is the value of property? Already they have given you 245. Annual exemption this year and the previous year, and 239. You have made a gift of 325, 250 of cash to Mario, but remember from here also annual exempt amount you have to deduct. And deduct it from 325. This much is available of nil rate band. This is your taxable amount charged at 40%. This is your IST. 63,200. So you have answered the first part. Now we are going to sell the shares. And you need some calculations. What is the first part of B says? Income tax and capital gain tax implications of selling their shares. You have to read that section. So here you have subscribed 120,000 shares, 50 newly issued shares. It's a UK resident company. These shares are qualifying EIS shares. So EIS means 30% income tax reducer on this 120. Already they have given. So the EIS relief is 36,000 against his income tax liability. Now, Louis elected to defer the maximum amount of gain. No partial amount. All the gain that he will get, he will defer on the sale of new house as a result of acquisition of this share. Can you understand? What is he doing? Whatever the gain he's going to get, he's going to defer it. Rather than charging it to IST, it will be deferred because he's going to acquire these shares, and these shares are EIS shares. So you can defer your gain. Already gain on chargeable, gain on the house has been given as 71,000. So now when you're selling the share, you're selling it to an unconnected person for 85,000. So first we'll talk about income tax impact, and then we'll move on to the CGT impact. Okay. If you see, he's selling the shares on this date, 1st April 2024. Let us see. Yes, 1st April 2024 he's selling the shares. When did he get it? 1st June 2022. Less than 2 years. So he is owning it for less than 3 years. Because he's owning it for less than 3 years, whatever the income tax relief he has got earlier now will be withdrawn. When he acquired the shares, that time he got some income tax relief. Now it will be withdrawn. What was the amount that was given as relief? 36,000. 30% on 120. Now when you're selling the shares to an unconnected person at a loss, the amount of relief withdrawn will be calculated by reference to the sale proceed. So how much you are selling it for? 85,000. And what was the relief? 30%. So this much. 25,500. It's always on your sale proceed. The sale proceed is 85,000. This one. The relief you got was 30%. Now it's withdrawn. 30 into 85, 25,500. Now we'll take the capital loss. Calculate the loss. But this loss will be reduced further by the EIS relief that you have obtained and that is not withdrawn. Remember, your entire EIS relief is not withdrawn. Okay. So what is the proceed? 85,000. You have bought it for 120. EIS relief was 36. Out of it, only this much is withdrawn. So whatever is not withdrawn is this. 36,000 minus 25,500. The difference is not withdrawn. So this not withdrawn is deducted from the 120 cost and you get this as your loss. Your loss is reduced further. Okay. Now, we have not moved on to the capital reliefs available for capital loss. We are still here. But remember, there is a gain from selling the new house. So you house, when you are getting a gain, and this gain was deferred because you have acquired this shares, now will be charged, will be brought back into charge. Now it will be chargeable. Earlier it was not chargeable, it was deferred. The gain on the sale of the U house. So as the amount reinvested, how much did you reinvest in qualifying shares? 120,000. What was the gain on disposal of the house? 71,000. The gain was 71. You have reinvested 120. You have reinvested more than the gain. So the full amount of the gain will be deferred. Why full amount? Because always refer to the case study. They told Louis elected to defer the maximum amount. So because you have deferred the entire amount, that gain will become chargeable in the tax year 23-24. Very important is which tax year it will be chargeable. Please go back and check. You are selling it 1st April 24. So 23-24 it will be chargeable. You have got the relief this tax year, previous year. This tax year it will be chargeable. Now relief available for capital loss. It's a capital loss. You're going to get a relief. So you can offset this loss on disposal of share against the gain of 71,000 again the U house. So how much tax is it, CGT is it going to save? At the rate of 28%, because he's a higher rate taxpayer. They have told you. Louis is a high rate taxpayer. So, and it's a residential property. So residential property at higher rate is 28%. Now remember, you have to talk about options of reliefs. This is just the rate that you are going to save that you have talked about. Options you will talk here. These are the options. This para. And then you have to decide which is the best. You have to give the options. So because they qualify for EIS relief, He can offset the loss against the current tax year or the previous tax year. That also against total income. In this tax year, if you see 2020, 22, 23, this is why you need each information. See, they told, I'll highlight it for you. This tax year he was an additional taxpayer, but all the other he has been higher rate. So we don't want him to waste any of the tax. Wherever he's paying the higher tax, get the loss relief against that tax year. That's advisable. So because in this tax year 22-23 he was an additional rate taxpayer, better to utilize the loss against that tax year rather than 23-24. So this will save your income tax at 45%, and any balance will then be charged at 40%. In this tax year, he's high rate. So you have to give both the options. Even though this is not, but in the conclusion of one line, last para, here you have to write which is the best, most tax efficient. But here you have to explain all options, both the options. So in this tax year, he was a higher rate, he will save tax at 40%, balance at basic rate 20%. So which one is advantageous? Offsetting the loss in this tax year against when he was an additional rate taxpayer. So he can save tax at 45% compared to 40%. This is more advantageous. Now, the last one. C. Income tax on interest received, income tax relief on interest paid. When you are paying interest, you are getting income tax relief, and when you are receiving interest, you have to pay the interest. You have to pay the tax. And then your after tax when mortgage not repaid and mortgage repaid. Three things. So we have to read this part. This part we have to read. So he have deposited the whole of the proceed. Annual interest is 850. He wants to withdraw the deposit fund and use the money to repay the mortgage loan. One of the residential property, not Ivy Cottage, and interest 1275 is currently charged on this mortgage loan, and he's a high rate taxpayer. So how much interest is going to receive? Because he's a high rate taxpayer, he's going to get a savings income nil rate ban of 500. Excess of 500 will be taxed at 40%. And tax relief, remember, you will always get at basic rate only 20%. And if you are paying any interest for the mortgage property loan, this will be given as a tax credit. That means it is deducted from the income tax liability. Now we'll do the calculation part, the last part of this question. So now you have to calculate only. Calculate. They didn't tell you to explain anything. So how much interest you are receiving? 850. And then on this 800 receive, you have to pay income tax. How much? 850 you have to deduct 500 because 500 is the savings nil rate ban and it will be taxed at higher rate because he's a high rate taxpayer. Deduct the income tax from interest received. Then interest paid part. You are going to get a tax. How much interest is paid? This much. This has been given in the question. And you are going to get tax relief on that interest paid. How much? 20% on 1275. Because of tax relief, it's added 255. And this is your net interest paid. You are paying more than you are receiving. That's why it's net interest paid. When you're not repaying your mortgage. But when you are repaying your mortgage repaid, you don't have to pay any interest. That's why it is 0. Now you're receiving any interest, it is zero because you don't have any loan. You see, when we are repaying mortgage, no interest relief. So whatever the deposited fund he have withdrawn, he will use it to repay the mortgage loan. So if he uses all the deposit, he's not going to get any deposit also. He's not going to receive any interest, nor he has to get any interest tax relief. That's why it is zero if he repays the mortgage. So the difference, he's going to save 310, the difference from 310 and 0. So the after tax interest saving will be 310. If he's not repaying the mortgage, he has to pay 310, and if he's repaid the mortgage, it is 0. So the difference is 310. That's what the requirement asked you. And that's it for this question. So I shall see you with some more revision kit questions, but it will be for your June 2025 session. But it will be on your new financial year at, which is financial at 2024, the new one, the updated one. So this is the last question for this March 2025 exam. Best of luck for your exam, and make sure that you do the questions on your other revision kit as well. Thank you.